Sunday, March 1st, 2015, getting ready for the first full week of trading in March. And I want to start out looking at Tesla, because Tesla, we've been talking about it for the last few weeks now, and just always talking about Tesla in general. And nothing has changed yet. We are still in this channel between 200 and 225-ish, 230 that we've been in since December, with brief moves above 220 in the early part of February and late December, and some brief moves below 200 in mid-December, mid-January, and also mid-February. What's interesting to me, though, is what Tesla did over the last week and a half. So you look at this stretch right here. You had a 2-day move where you went from 205 to 220 and had every chance to break out, or if not break out, stay up near 220 and start challenging this resistance around that 225, 230 area. And Tesla did not accept the challenge. She backed away from it, and backed away from it hard. Gave up the move, the 2-day move, in pretty much just a day and a half. And this is something that I look for in terms of, velocity, trade velocity. How quickly is a stock giving back gains? How quickly is a stock making up losses? Well, in the case of Tesla, she gave up gains very quickly this last week from that 2-day move, and I think that could be a sign of just some vulnerability overall. But the important thing is to remember that until she actually does break below 200, we don't have an official breakdown, and I want to do my best to avoid predicting that a 200 breakdown is going to happen, because my belief is that predictions don't make me money, reactions is what make me money. So I will be watching for a 200 breakdown, though, because if you get it, I would expect a downside reaction, and I'd be looking to trade that. And the key supports will be the February low at 193. That was the earnings day low. And then the 52-week low is at 185. That is the January low so far. If you break below 200 bucks, I'm looking for a move down towards 193 to 185. And if you were to break below those supports, it could really open up to the downside. We could be looking at 170 on down to 150. So Tesla, definitely on watch for that 200 breakdown. What happens if you never get the 200 breakdown? Well, as we discussed at the outset, you've been in a channel with 200 being the channel support. So if you don't ever get that $200 breakdown, then I would look for a bounce off this channel and a test back up towards 220 to 225. But on that side, you still have the same story. You still need to get back above 225, get a breakout above these resistances here to really trigger this thing to the upside and start going back up towards 250 and 260s and the all-time highs. So Tesla, very intrigued, because it is ever so close to a $200 breakdown. It's the only stock in my primary list that is currently testing a $100 level. So I'll be keeping an eye on that. Another name I want to talk about is Priceline. Priceline had some good developments over the last couple of weeks. She, number one, got a hard bounce, partly due to earnings, but part of this bounce was underway before earnings started, and she's now kind of consolidating that move. But this trend line right here that you see, guys, that she just started poking her head above, that's an important trend line to me. That is the downtrend off of earnings. I'm just going to, off of the all-time high. I'm just going to go back here on the daily chart so you can see it more clearly. So this got established when you had this top in August 2014. Here's the all-time high up near 1375 from back in February, March or so of last year. And then you had this test in August and that got rejected, and you can see she then again tested it here in what looks like late August, early September, and then tried to get up to it again in November, got rejected, didn't get close enough, and then never came back up towards it until you just broke out on earnings. And you can see this pretty clear here. So, depending on where exactly you draw the trend line from the all-time high, it might be a little bit different, but regardless of where you draw it, you should have price line starting to poke its head above that downtrend line. And I really liked the movement that we saw on Wednesday the 25th. Opened at 1220, hit 1260s. She was a great trader intraday. So keep your eye on price line for more days like the 25th. I mean, it's an expensive stock, but in the options market, you get a 40, 50 point range on a $1,200 stock. There's going to be a lot of strikes that are going to be moving. So Priceline will continue to be in focus. Overall, to me, I like Priceline to the upside long term. Now, as long as she is staying above this 1200 area, holding on to the gap up that it did off of earnings, I think you can find your way back up towards 1300 within the next couple of months, maybe even much sooner. I want to look at Twitter for a moment. Twitter's been very popular, a lot of different opinions out there, and just want to point out that the stock still hasn't really made a secondary move off of the earnings move from a few weeks ago. Talked about this last week. That $50 breakout is what's going to trigger Twitter, and you had, you got up to 48.50s on big volume. That's the earnings move. But now you haven't really extended beyond 48.50. You still haven't gotten above $50. I know some people, I got some questions. Hey, what do you think of Twitter? Got rejected at $50. Yeah, it got rejected at $50, but it's essentially where it was 2 weeks ago. It's where it was 3 weeks ago. So it's just kind of consolidating. It hasn't broken out, but there's nothing to be discouraged about in terms of, okay, now I'm looking for downside. What would change my mind on that is if you start breaking this pattern of higher lows. And the first level you're going to want to watch is your low from not this past week, but 2 weeks ago, February 18th, 47.35. I either round up or round down, so I'm just going to say $47 is the level to watch. As long as you stay above $47, I don't think there's much to worry about on Twitter. I think this consolidation continues. As for, hey, when does that really good upside trade happen? Well, probably not until you get a clean $50 breakout. Those were the charts that I wanted to highlight on my end. Anybody with any chart requests here before I dive into the questions we have? Chart requests going once, going twice. Oh, we got one. Google. Okie dokie. I talk about Google in that video that I posted on YouTube, by the way. But we'll talk about it here briefly as well. So Google did some good things. Finally got above 550 cleanly. 550 has been a very annoying level for Google. And what I like is not only did we get above it, we pushed directly into the 560s right away. And that is a major difference than the previous few voyages above 550 that you've had recently. You look on February 13th, you closed above 550, next day closed 540s. You go back, you look January 23rd, you got up to 545, next day you closed into 530, so you couldn't keep going towards 550. If you even go back into November, got up on 551s, 552s, couldn't stay up there, came right back into the 540s. This time, on Thursday, you closed 559, and then Friday you kept pushing, got into the 560s, printed a high of 569. Yes, you closed off of that high, but it's still a moral victory, if you will. You know, we finally got some extension, finally have some breathing room above 550, and I think Google is a nice, simple setup now. As long as you hold 550, Google is going higher. As long as you hold 550, Google's going higher. No reason to overcomplicate things. If you were to come back below 550, then I would look for a pullback back down towards this 540 to 530 area. But again, I'll say it, as long as you hold 550, Google's going higher. Key resistance that you're going to want to watch, well, first of all, Friday's high, 569, and then I would just say on up to 575 psychologically. But if you could clear 569 to 575, then I like Google for continuation towards $600, and the all-time high is right around there, and you know that would certainly come into play. So okay, another one, BBRY. Well, BBRY, clear channel here. You know, you haven't gone anywhere major over the last 6 months, so I personally have a hard time committing to plays like these because nothing has happened yet, and if you're going to buy it before something happens, then you're obviously betting on something happening, and I don't like betting on movement to happen where it hasn't yet happened. I'd rather bet on movement to continue happening where it is already happening. So BBRY is kind of in the former category. But with that said, if you can stay above $10 just psychologically, I think you can start moving to the upside. And you're trying to get above this key resistance around $11. You're up 4 days in a row. So she's trying, but again, I really need to see some breakouts before I start getting bullish on this name, and I need to see some breakdowns back below $10 before I start getting bearish on this name. So just kind of neutral, kind of a hold to me. I do recognize BBRY as one of the more liquid and tradable names for day trading purposes, scalp trading, and whatnot. But as far as really thinking about, okay, where is this thing going this week, this month, this year, I just can't really make a good bias off of that because you haven't gone anywhere for the last 6 months. You have been at the exact same prices each month over the last 6 months. So get an $11 breakout, and then we can start talking about BBRY more. If you want to see a stock that is making a move, you just need to look at the one that was just requested, and that's Monster, MNST, Monster Beverage Corporation. This stock has just been a beast. I mean, it's been a monster. No pun in, actually, there is a pun intended on that. Just solid uptrend, and it does this thing where it just goes higher every month and then gets these big gaps higher periodically. You saw it back in August. You gapped from $70 to $95. Are you kidding? And then you just did it again, just consolidated higher, and then you gapped from 125 up to 140, just massive. So it looks like a great name to sell puts on. I'll say that. You know, if she pulls back a little bit, I'd look at selling some put spreads because she just has not shown any type of weakness at all. The only thing she's shown is she doesn't always keep going to the upside right away. You know, you can see these kind of long-term consolidations in MSTR. You saw it off of the last big gap up, and you saw it before this most recent big gap up. So I wouldn't be surprised at all if you put in a couple weeks or even months worth of consolidation off of this gap. But overall trend unquestionably to the upside, and don't expect that to change until it does. You know, we always try and guess when is a trend going to change. We try and look for stuff to say, oh, okay, this looks like maybe it's a topping pattern or whatever, And what I've learned in my experience is, yeah, that's all well and good if you can get it right. More times than not, you can't, and you're better off just not guessing and actually waiting for it. Hey, you didn't sell the top, but you'll get more certainty, and you can make better trades that way. So Monster is one of those cases where I think you probably got a lot of people that say 140 bucks, Monster? No, this thing's got to top out. And it's like, well, no it doesn't. And if it does, I'm going to let it top out without me first, and then I would look and try and catch some downside. Okay, so I want to move on to some questions here. Got some good ones. First one has to do with increasing your size. And this trader asks, how do I know when to increase size on my positions? Do I wait for my confidence to build or my trades to show good results? I think it's kind of, those two things go hand in hand. Once you start to show yourself good results, it's only natural, whether it's trading or playing a sport or an instrument or academia, whatever, you're going to get more confidence in your ability. So yes, I would wait for yourself to show good results, because once that's happening, you're not going to have to wait for the confidence. It's already just going to be there. That's how it is for me anyway. That's how it is for most people. I'd expect it to be the same for you. And once you get to that point, I think, yeah, you start increasing your size. Now, the mistake people make with increasing size is they try to go from driving 30 miles an hour to driving 100 miles an hour. And it doesn't have to be that way. And it shouldn't be that way, I don't think. The way you increase your size is you do it incrementally. You count from 1 to 10. You don't skip numbers. You go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. What I mean by that, if you're trading options and you've been trading, let's say, 5 contracts at a time for a year, and you're starting to do well, you're starting to gain confidence with that, you don't then go to 10 contracts at a time, because that may seem like a small number, but really you're increasing your size by 100%, and that's not the way to do it, in my opinion. What you do is then you trade 6 contracts at a time, and then after you trade 6 contracts at a time for a month or two and you continue to get good results and your confidence increases, now you go to 7 contracts at a time, then 8, then 9, and then eventually 10, and then you do 10 contracts for a while, and then you go to 11, and so on and so forth. I think what people do is they say, okay, I'm ready to increase my size. I've been trading 5 contracts my whole life, now I'm going to trade 20 contracts. And it's just like, wait, what? Why? That could be a little bit more difficult and a little bit more uncomfortable. So you want to get there gradually. You think about as we get older and just the way life works. I'm kind of weird, but I really believe in a lot of life and trading equivalents. We don't go from being 18 years old to being 30 years old. We go from 18 to 19 to 20 to 21, 22, So I think trading's kind of the same way. I gave the options example, but if you're trading shares, maybe you've been trading 100 shares of Tesla at a time, and now you're thinking you're ready to increase your size. Well, start doing 110 shares, increase your size by 10%, or start doing 120 shares. But again, don't double up. Don't start doing 200 shares. I think that might mess you up. So that is personally how I go about increasing my size. That's just my opinion. I think that's the right way to do it to keep things consistent, because when you change an element of your trading, such as your size, you don't want it to mess with the consistent aspects of your execution, ultimately, which leads to your skill and your ability. And if you were to really change one of those dynamics dramatically, such as increasing size by 100%, that could really mess up with your consistency, I think. Next question. This trader is starting to put together an IRA portfolio, and wondering if I have any suggestions for me to look at. Currently, they have Google, IBM, SRE, and they're also looking at DLR, which is a stock that I mentioned I bought on Friday. This is an area that I need to be very careful about, stock recommendation, long-term stuff, just for legal purposes. But what I'll say is, with my experience, I buy stocks that I know, stocks with companies that I like, where I feel like long term I have an understanding of what that company is doing. So for me, I'm invested in Twitter long term, I'm invested in Tesla long term, I'm invested in Amazon long term, I'm invested in Kate Spade long term. Those are the only 4 stocks I own long term right now. And I'll just go through those tickers. Tesla, why do I own it? Well, if I had $100,000 of spare cash, I would go out and buy a Tesla because it just kind of looks like the coolest car on the market right now to me for the driving that I do and the city I live in. If I lived in a big open area, maybe I'd buy a nice fast-ass sports car, but that's not the way it is. I want to save money on gas. I just want to get around and I want to do it in a nice car. If I had the money, I would buy a Tesla. So that's why I own Tesla, because I hope one day I do have the money. And I believe in the product that they sell, and I am familiar with the stock. I think those are the 2 key ingredients long term. Being familiar with the product you're investing in, wanting the product you're investing in, and being familiar with how the stock itself actually trades on a day-to-day, week-to-week basis. So like for me with Tesla, I know when Tesla drops hard, that's when it really gives its buying opportunities. You don't want to step into Tesla when it's going up. That's why I've got an order sitting down at like $175, because if Tesla does break down below 200, I'm going to be a long-term buyer. I'll be shorting it day trading wise, at least I think I will, but I'll be a long-term buyer on the stock overall. Then Amazon. So I bought Amazon, started buying it last year. The reason I started buying it is because when I started running this business and putting together the things I need and the equipment, my monitors, my computer, filing cabinets, a new desk, a new chair, all that stuff, I just found myself going on Amazon all the time for this stuff. Literally needed something, I'd go on Amazon. I signed up for the Amazon Prime, hey, free shipping, whatever. So I had looked at Amazon then long term, and as I saw, hey, this stock had just dropped from $400 to $300. Well, that looks like a decent entry point. I'm getting it 30%, 25% lower than it was. I started buying it in really just May through August of last year. So that's why I bought Amazon. Again, I like the product, I use the product, I understand the product, and I understand how the stock trades, so I stepped in there and took a long-term position. Twitter, I'm on it all the time. Watchhimtrade, that's where we're getting a lot of new business from. Maybe some of you guys watching this webinar right now, you might have found us on Twitter. And, so, hey, common sense there, right? If this company is helping me advance my business, then I kind of believe in their long-term potential. I think it just makes sense for me to be invested. And also, seeing what Facebook has done stock-wise over the last few years, thinking, hey, Twitter's kind of in the same space, maybe she can follow that same trajectory. And then lastly, Kate Spade. Well, this one's a little off the beaten path, but my girlfriend has a shopping addiction, and she raves about Kate Spade's products. So I was like, well, my sister likes it, she likes it, I'm going to go ahead and buy this one just because it's a little bit different. I don't shop there, but I trust my girl's judgment. So, wanted a retail name. So that's what I did in owning Kate Spade. With me, I keep my IRA positions pretty narrow, meaning that I'm not spread out over 10 to 15 stocks. I'd rather put a greater amount of money in a few core positions and, hope that a couple of them do well. Such as last year, I wasn't in that many stocks, but I was in Tesla with a good chunk of my IRA account. And Tesla ended up being a real home run, going from like $100, $110 was my average, and it ended up hitting $290. I sold a decent amount between $220 and $290, and that worked out for me. And this year, it's kind of looking like Amazon is on its way to being the big driver of performance in my long-term account this year. So, it's just important, I think, to find a couple really good ones that you can rely on to make a nice long-term move and go from there. One thing I do with my long-term account is I always keep a large cash position available, and my account's only $22,000, but by large cash I'm at about 45% cash. And the reason I do that is so that when one of my favorite stocks does take a big dip, such as maybe Tesla, I can then step in and build a long-term position at favorable prices. If Tesla drops 20% from here, I'm going to be buying a good amount instead of having to sell off something else in order to step in and buy some Tesla. So, the three stocks you're looking at, Google, IBM, and SRE, I would say if you're looking at them, you're probably looking at them for a reason. And, trust whatever reasons you have, and make sure that you like how the stocks are acting. I've had long-term positions go completely to dog shit, and I think it's important that even though you're long-term, you still want to see the stock react the right way. So I'm looking at a chart of Potbelly right now, PBPB. This is a sandwich company based out of Chicago. I ate at this place all the time when I lived in a neighborhood up north. Don't eat there so much, but so when they IPO'd, I bought Potbelly because I was like, Chipotle's done so well. It's a Chicago company. I'm familiar with it. Blah blah blah. I started buying this stock between about 24 and 28 or so, and as you can see, now it's down at 13 bucks, 13 and a half. I sold Potbelly at about a 40% loss. I was in it for a while, gave it the benefit of the doubt. But once this breakdown happened right here, back in February of 2014, I started looking for an exit and started selling once it went below 20 bucks and sold on the way down towards like 17. Point being, hey, I believe in the company, I like the company, but the stock wasn't acting right from the time I took my position. And I'm not just going to let an excuse of, hey, I'm in it for the long term, keep me in a stock if I don't like the way it's acting. And that's the difference between me and somebody like my parents, who my parents never sell a stock at a loss. It doesn't matter. It could go to zero before they sold it at a loss. My parents are still in Potbelly, in fact. So that's where you kind of have to establish who you're going to be as a long-term investor. Even though I'm long-term, I still want to see a stock acting the right way and not getting away from me too badly. I just want to wrap this conversation up also by saying we could talk about it a lot, this idea of long-term investing, but it's just very important to do something that fits your style, your strategy. You could do dividend plays if you want. You could do bonds. You can do municipal investments. There's all types of different directions you could go. Whatever you do, just make sure you understand what you're doing. Next question and last question is kind of a twofer. The first part of it is in regards to level 2, and noting that I really seem to rely on level 2 a lot, and this trader just asks, is that my sole strategy and main criteria for entering and exiting a trade? I will say it is a huge chunk of my strategy and probably the most important part of my strategy when it comes to entering and exiting my positions. The other element that's important is you see all these tapes right here. You've got Tesla, Netflix, Amazon. You've got my primaries up here. The first thing I do, the first screen I look at, I've got 3 of them up here at 9:30, is this one. And what I'm looking for is which stock is moving the fastest, which stock is what I call making a break out of the gate with some really good speed. Tomorrow morning at 9:30, if Tesla opens and it immediately makes a break down towards 202s, 201s, you better believe I'll focus in on Tesla and say, hey, is this thing setting up for that 200 breakdown? And then that's when I'll shift my focus to my other screen and kind of watch my level 2 right here, which, you know, it's not up right now because it's Sunday, but it will be tomorrow. And then I'll kind of hone in on level 2 and say, okay, what's going on here on the bid and the ask. But the first part of the strategy for me is trying to get a feel for tape speed and, you know, picking up what is showing movement right out of the gate. And then after I feel that I've identified where the movement is happening, then yes, using level 2 to then say, okay, looks like it's a good entry here, looks like it's a good exit, whatever. Other aspects of my strategy, I will look at a chart. I'll use a 3-minute, 15-minute, 60-minute chart. I find myself using them less and less with really each week that goes by. I just think I'm getting more confident in only using level 2 and time and sales, but I'd be lying if I said I don't use charts at all. I will say though, I don't use charts to pinpoint an entry, guys. I think a lot of people are using charts to say, okay, this looks like a good area to get in, this looks like a good area to get out. That's all well and good, and if you do that and, you know, it works for you, more power to you. I really just kind of have my $5 levels and my 0 levels. I think we've talked about that in previous webinars, just kind of round levels, getting in at round levels or getting in at break-even prices, and, you know, watch level 2 and go from there. Second part of the question in regards to strategy is, what do I think of the 15-minute breakout breakdown strategy? This is a good question, and what I think of it is the same thing I think of any strategy. If you can prove to yourself that a strategy is working for you, then you should use it as many times as you want. So let's just kind of go over the 15-minute breakout and breakdown strategy. And what it says, for those who aren't familiar with it, is you take the first candle on the day, on a 15-minute chart, and you simply draw horizontal lines at the bottom of the channel and at the top of the the bottom of the candle and the top of the candle, and a buy signal is triggered if you move above the top of the channel, and a sell signal is triggered if you move below the bottom of the channel. So on this day, we're looking at Tesla on February 20th. You opened 210, closed that first 15-minute candle at 214. Next candle, you gave a buy signal breaking above it, and you can see it did work very well, and, you know, made a nice move. And then what you do for a stop out is you use the previous candle's low as an exit point on the stop loss side. So for instance, when this buy signal triggered, your stop loss would have been, you know, down near 210 originally, and then you would have bumped it up to about 213, which was the base of that low, and then you would have bumped it up to about 215, which was the base of the next candle, and so on and so forth. So, and you can see it worked out very well. Now if we just go to the next day and do the same thing, you had a breakdown trigger. You got a sell signal right away. Right away after the first 15-minute candle, you had a breakdown below that initial 15-minute low at 215 and broke down, and then made a really nice move from 214 all the way down to 207s. And you can see now we would flip the stop loss, and it would be the previous 15-minute candle's high, since we got a sell signal when we're short. And you can see Tesla didn't give a stop out until she had already dropped from 214 down to 210 for a nice move. Stopped out, but then it reaffirmed the signal and then made another move down from about 210 down to 208 before giving a stop out. So there's a couple examples there that shows it working. And this strategy does work really well when you get directional movement. Directional movement meaning up, down. When it doesn't work is when things are pretty sideways. And if we, again, just kind of stick with Tesla. So you can see the next day after that big drop, you know, we went from you technically triggered the sell signal, but then you just kind of stayed sideways and came right back into that 15-minute low, right? And then you see the same thing the next day. Just wasn't a ton of movement. So what I generally say for myself when I used to use this, and yes, this is being recorded, what I used to say for myself is, if you are going to break out or break down out of that 15-minute range, there's no reason to come back to the range. Okay, because if you start coming back to the range, that signals sideways price action. And what I mean, you can see that played out on February 25th. You broke below the 15-minute low, but then you came right back to the range with the next few candles. Okay, and you can see the same thing on the next day, February 26th. You initially broke below the 15-minute low, right? So you trigger a sell signal here, but then with the next candle you come right back into the range and just kind of negate it. And yeah, you made a spike up, but if you notice, you more or less ended up kind of being sideways on the day. And then Friday, you just kind of had some soft downside. We'll look at one other example, and then I'll just have some comments on this strategy in general, because it is something that I did used to use myself. I want to point out Priceline, because Priceline, when she made her move, it was just an awesome use of this 15-minute breakout strategy. So we put the high here, and this was on the 25th, and you can see you broke out above the 15-minute high, and notice you never came back to that 15-minute range. You never came back to revisit it, and never really went below the previous 15-minute candle's low, not until she had gone from 1225 up to 1250. So you were able to catch an awesome move on Priceline. Then she kind of triggered another move going up towards 1260s even. So Priceline, just a beast of a move on that day. So what I'll say in regards to this, for me, I believe the best trades happen right at the open. I think that's when you get a really good move most of the time. And you know, I like trading the opens. If you use this strategy, it doesn't mean you can't trade the open, but if it's the only thing you're using, you're immediately limiting your opportunities. Some people don't like trading the open, and that's fine if you don't. This doesn't really apply to you. But if you're somebody that's trying to get better at trading the open and you're kind of scared about it, I got news for you. There's only one way to get better at trading the open, and that's to gain experience, and the only way to gain experience is to start doing it. So that's my only gripe with this strategy, is you need to wait before you can see it kind of develop, and by that time there may have already been a good trade. But I do think it's a good strategy. You just want to find where it's working and avoid where it's not. You want to kind of make notes of the intricacies of the strategy, if you will. Like how I said, you shouldn't be returning back to the initial 15-minute candle. You shouldn't be coming back into that range. That's kind of a sign of sideways action. That's something that I didn't incorporate into the strategy until I saw it happening a bunch, and I said, okay, well, if it comes back, that's a no-go, and kind of stay away. And then also the other thing I mentioned, using a stop out if you go below the previous candle's low or go above the previous candle's high. Some people say you don't stop out until you get a close above the previous candle's high or below the previous candle's low. So, you know, different things. You might tweak it and do whatever you want. But again, any strategy is a good strategy if it has proved profitable for you. Alright guys, those were the points I had, the questions that were asked. I appreciate the participation, some good questions in here today. And I also want to say, keep doing it, keep making use of the webinar question submission. I just want to show this so everybody knows when you have a question, you just use this submit one button here and you can submit a question directly from the site. You could have a question for next week. It doesn't matter. You can just submit it today or submit it tomorrow. You don't have to submit it the day of. I get all of these questions from here, so I encourage people to use this. It was nice to look in my inbox this weekend and see a couple people using this tool because that's what it's there for. Any questions on anything we discussed? Alrighty guys, not seeing any questions. Well, thank you guys for attending. Another good participation in here. 2 weekends in a row. Nice to see. I will see you guys in the chat room tomorrow morning, and let's have a good week. Thanks guys. Have a good rest of your night.